All right, let's go ahead and get started. So, if you haven't joined me or anyone else for study time with Steve in the past, this is a series of webinars that we do, just kind of talking about the markets and what we're seeing. I'm Steve Gormley. I'm the Director of Portfolio Management for KWB Wealth. Today, I'm going to be joined by CEO KERRY BUBB and Executive Wealth Managers Robert Bullock, Diana Saylor, and Mike RAZZOUK. Obviously, this is a little bit different than some of the times we've done it in the past. Usually, it's me and one other advisor kind of talking for maybe 15, 20 minutes and then taking some questions. This time we're going to go kind of a speed round through some slides, and then we will have the advisors give some words of wisdom as we're in a little bit of a different time right now. And then we'll open it up for questions. So here we have some important disclosures before we get to the bulk of the presentation. And let's begin. The first thing I always like to think about in times like this is Warren Buffett's quote, be greedy when others are fearful and fearful when others are greedy. Right now, we're looking at some extreme fear happening in the markets. This was from April 7th. I think we even hit a signal of 3 on the extreme fear gauge index a week or so ago. And basically, this is just showing when we have extreme fear, that's the time when you need to be greedy.
And Steve, I think you said there's only been that low one other time, and
Yeah,
it actually hit 3
yep,
during COVID. Is that
yep,
correct?
during COVID. Yeah, not even during 2008. So COVID was the only other time that it hit that low of a mark. So really, really extreme fear out there right now. So this second slide shows the times in the past that we've had 2-day drops that have been 10% or more. You can see we didn't have any since 1950. We didn't have any until 1987. Kerry started his career right before then, so I'm guessing it was his fault. And
No,
and
I was the
yeah,
cause for the rebound. I was the cause for the rebound.
but it's one of those things where you don't see this happen very often. And when it has happened in the past, it's been kind of a sign of a bottom. So the bottom of this chart, you can't really see that well, but I'm going to blow it up for you here. And you can see the times that it's happened in the past. Uh, 1987, 2008, it happened twice, and during COVID, it happened. And you can see what happens after this happens. So 3 months out, an average up of 6.6%, 6 months out, an average of 15, almost 16%, and 12 months out, an average of 32%. So this extreme sentiment, extreme fear, extreme selling, all kind of leads to above average returns as you look out over time. And the final slide I'm going to show, I showed this during the first ever study time, which was a few years ago, and I quoted one of my favorite movies as a kid, Ace Ventura, Pet Detective, and what he says that at one point he says, if I'm not back in 5 minutes, just wait longer. And that quote kind of shows up in the markets as well. So if you're not happy with your returns over a day, over a week, over a month, just wait longer and things will get better. So this shows over time the historical odds of the market going up over any specific holding period. So if you wait 20 years, you got a pretty much 100% chance that the market's going to go up. 10 years, 93% chance. But day by day, it's basically 50-50. You never know what's going to happen. So we have a nice chart here in the office on one of the walls that says, are you investing for days or are you investing for decades? And, for us as long-term investors, we're definitely investing for decades, not just for days. So that's all the slides I have today. I'm going to open it up for the advisors to talk and just kind of talk about the sentiments they're hearing from their clients and maybe some words of wisdom that they're giving at this moment as well. So,
Good.
Kerry, why don't we start with you?
Yeah. So a couple things that I've been hearing over the last weeks and maybe months, if you will, is, hey, Kerry, this time it's different. And one of the things I can tell you is every time we go through this, I hear this time it's different. And then of course I say, no, 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 this time it really is different. You know, whether it was the 87 crash, whether it was the tech bubble, whether it was the terrorist attack in 9/11, whether it was the financial crisis, and somehow we seem to manage to get, through it. What I did recall is in January, as we did our economic outlook, I said, one thing I worry about is I don't see much to worry about. And that did worry me because when I was sitting there, I said, boy, the unemployment numbers look good. Inflation is coming down. The Fed is likely going to continue to lower interest rates. I just didn't see a recession. And even at that point, we knew Trump was being elected. I think we did it right after he was not nominated, but took over the oath of the office. And, I don't think I maybe gave as much thought to maybe his bark versus his bite. In other words, he has said a lot of things about tariffs, and we kind of anticipated that. I think what we probably misjudged or whatever was the way that he would, deliver the message of the tariffs. One day they're on, one day they're off, one day they're 10%, one day they're up 40%. And the messaging has really been what has caused so much frustration, I think, for the markets, is we just don't know what to expect. What I will say is that looking even today, it's still hard for me to see a recession. We have interest rates, still pretty low, probably going lower. The Fed has some, bullets in the gun so that if things get a little bit more scary, they can come in and lower interest rates. I think he's playing poker, with China and other countries, and, making sausage isn't very pretty when you see how this is done. I think also that, you know, at this point in time, history tells me is we're going to sit here in probably 3 or 9 or 12 months and look back and say what a buying opportunity this was. In the meantime, I know it's scary. We don't like it either. It's uncomfortable. And I think one of the best things that I do personally to get through some of this stuff is just don't look at your statements every day and try to step back and not watching the news and the sensationalism of the press and the media. That doesn't help. I don't think personally that, he's out to destroy the economy. And I've heard all kinds of different notions from people. I'm still pretty optimistic about this country and the long-term outlook, for it. Yeah. So why don't we let Bob go next, and then we'll do Mike
Sure.
and Diana.
Sure. You summed up a lot of our thoughts. My words of wisdom sort of goes back to, I hear from clients of, my goodness, should we make these all or nothing decisions? Should we stay in? Should we get out? And let's get out. I feel better, but then we can decide when to get in. And I really caution people from making those all or none decisions. You've got typically a balanced portfolio of stocks and bonds. I'm reminded of my mom, who retired in her 60s, died a couple of years ago in her early 90s, had a 60% in stocks, 40% in bonds, tweaked it along the way, and went through a lot of the 9/11s to 2000s to 2008s, and never made all or none decisions, but kept it balanced, reminded herself that she's a long-term investor, and that served her well. She had more money at the end than what she started with. So I really caution clients. I know it's fearful, and I would concur with Kerry of don't look at the statements when you are fearful of what's going on and what your account looks like, but remind yourself that you're a long-term investor. We'll tweak it along the way, but don't make those all or none decisions. Diana?
Yes. So speaking of long-term investors, so I get the question a lot, or the comment, Diana, I don't have time to make up the losses, or Diana, I'm retiring soon. Maybe I should change my allocation. So just remember back in 2008, it was awful. We all experienced it. It was a terrible time. But if you had a 60-40 portfolio, like you alluded to, Bob, it took about 2.5, 3 years to recoup. And so most of us hopefully have 2.5, 3 years to make that up. And so, we also encourage people to look back at your plan. We've created these financial plans for you all. We've used conservative return assumptions. And so we're planning for dips, we're planning for recessions, we're planning for all these things. And so it's go back to the plan, and we can remind you of what we put in the assumptions, and that should bring you comfort.
Mike, go for it.
What I always remind people of is I get asked the question, what are you guys doing about this? And I try to reframe it and say, it's not what we're doing, it's what we already did. You know, we met with people, we tried to figure out ahead of time, what's your comfort level? What's your risk tolerance? What kind of, downturn can you actually stomach? And then what we did ahead of time is we matched your time frame with your allocation. So your portfolio is made to weather these kinds of storms. So we have bonds, we have alternative assets, we have things in the portfolio that when the market goes down, we're picking on those. You know, bonds have actually gone up in price. And so the big point just being stay diversified. You know, this can be scary if all your money was in QQQ and the NASDAQ, you know, things like that, where maybe you might be down 25%. But diversification smooths out the ride. It gives us as advisors, when somebody's taking income, something that we can pick on at an attractive price. And if somebody has, 30% of their portfolio, even in bonds, even if it's 15, the intent is maybe that's 2 to 3 years worth of income that we can take from those assets that aren't down at this point and get you the income that we need without having to sell stocks at an unattractive price. So just remembering that we had those discussions ahead of time. We had diversification in the portfolio to give us stuff to raise income. And then the other thing is we always recommend having a cash buffer. You know, the rule of thumb has always been 6 to 12 months. And that gives you the opportunity to slow down income from your portfolio if it's in an opportune time. And then when markets rise again, which they always do, we can refill that short-term cash bucket for people. So we can't predict when these events happen, but that's the game plan ahead of time. We're prepared. And like Diana mentioned with your financial plans, we're assuming 5% returns typically. You know, an asset allocated 60-40 portfolio over time is then closer to 8 if we go back over the last 15 years. And that includes terrible years like 2008, wonderful years like the last 2 that we had with markets. And so we rarely just get an 8% return each and every year. It's the average of the good and the bad together. And so we're prepared for it. And so is your portfolio.
And I just want to add in there that, when I look at the portfolios and when I meet with clients here just in the last couple of days, and I see the things that we've been doing, is I am very confident about the portfolios, about the asset allocations, about our strategy. I know it works, and it works over time. It might not work all the time. We have periods of months or weeks or things like that, but I absolutely am confident that the strategies that we have employed are going to see us, through the tough times. And it's very important for investors is not to begin to, question and all of a sudden change things in the middle of the storm. It's like in the military, you train so that when you go into combat, you're going to know and how to act. It's not the time to all of a sudden develop a new theory and go try something different. So for those of you that are concerned, I tell you, this strategy is going to work over time. You just have to give it the time.
And I would pop in by just saying that the strategies do work, and just prepare yourself emotionally to go through the good and the bad. I always use the analogy that the market's somewhat like California weather. 80% of the time, it's lovely, it's sunny, but we remind clients at times it's going to cloud up and rain, and we know the rain doesn't last very long. And we know that the sun will come back, and the market's the same way. So just prepare yourself for the roller coaster. As Kerry said, it's never fun. It never has been. Markets going down gives us the opportunity to increase the returns over time. And so we want the portfolio to go up and down. We want to take advantage of that opportunity. And if it's too nerve-wracking, as Kerry had suggested, then don't open those statements. Don't watch TV if you can. We know the bad news sells to begin with. And just hang in there. And if you really get scared, pick up the phone and call us. That's why we're here.
All right. It's been wonderful to see all you guys. I appreciate the continued confidence you have in KWB. We feel your pain. We practice what we preach. We eat our own medicine, our own cooking. So please feel free to reach out to us if you have any concerns. If you think your risk appetite is increased, we're here to help you. We want to have those good conversations with all of you. So thank you.
Thanks, everybody.